And we are continuing with the financial management model and the income statement. The income statement is a report of the farm business's financial performance during a given time frame. It measures profit or loss in a given time period. Every business produces a product. Product sales generate a return to the expenses incurred when making that product. The income statement is used to measure the cash income or revenues, cash expenses, and the financial value of non-cash income and expenses used during one production cycle, usually a calendar year for farmers. The income statement is also known as the profit and loss statement or statement of earnings. Most of the information needed to prepare your income statement can be found in your farm business's records. Internal Revenue Service or IRS Form 1040 Schedule F for profit or loss from farming, and the IRS Form 4797 for sale of business property may be used when creating your cash income statement. Your income tax return, although useful for verification purposes, is not a substitute for the income statement. The current beginning and ending year balance sheets are also needed for determining accrual adjustments. The change in capital assets can be found on IRS Form 4797 and will also be needed for the income statement. The income statement is structured into two parts: income or revenues and expenses or costs. As shown on this slide, the income statement includes three presentations of profits: income from operations, net farm income, and net income. Let's review how profits are calculated in the income statement. First, you'll review your revenues by totaling all cash farm income during your time period, which could be your fiscal year, like January 1st to December 31st. This income can be found on your IRS 1040 Schedule F and Form 4797, or from your accounting system. Cash farm income may include sales of livestock or grain, government payments, and other income sources. Next, you will need to make accrual adjustments from inventories that were raised and harvested for sale, or will be used in farm production. Not all of your farm income is accounted for in your cash sales. Your beginning and ending balance sheets during your time period are needed to determine the increase or decrease in values, such as differences in accounts receivable, inventories of feed and grain, market and breeding livestock. Adjusting cash farm income for accrual adjustments results in your gross farm revenues or total farm income. Next, you will review your operating expenses by totaling all cash farm expenses during your time period. Then you will need to make accrual adjustments from inventories that were purchased for sale or will be used in your farm production. Not all of your farm costs are accounted for in your cash expenses, such as differences of feed inventory and supplies, investment in growing crops, prepaid expenses, and other current assets. Additionally, you will need to make accrual adjustments from accounts payable and credit card balances that you use to purchase product or services during the time period, but have not yet paid for. Finally, you will need to adjust for economic or real depreciation, not tax depreciation, as reported on your 1040 Schedule F. Tax depreciation uses IRS guidelines to expense the cost of capital assets over a specific period of time. Economic depreciation reflects the real loss of the capital asset from use, wear and tear, or technically outdated. Adjusting cash farm expenses for accrual adjustments and economic depreciation results in your total farm operating expenses. Now you are able to calculate the income from operations by subtracting total farm operating expenses from gross farm income. This difference is the income from operating your business over the time period. Using the value of income from operations, you will subtract interest adjustments, which are considered the cost of financing the farm business and is not an operating expense. Next, you will need to adjust for the difference between the sales value and the cost value, which is either a capital gain or loss. And you can find this information on your IRS Form 4797. Adjusting income from operations for interest adjustments, capital gains or losses, and other farm income or expenses results in your net farm income. Using the value of net farm income, you will subtract taxes, which can be found on your IRS Form 1040 or from your accounting system. Finally, you will need to add or subtract other non-farm income and expenses that have not been accounted for in your farm income statement. Adjusting net farm income for taxes and non-farm income and expenses results in your net income. The net income amount provides for your family living expenses and principal payments on debt. In review, net farm income is a standard measure of profitability for the farm business. Generating a profit provides an opportunity for the farm business to expand, replace capital, reduce debt obligations, build working capital, and cover unpaid family living expenses. NFI should be increasing and providing an economic return for the owner's equity, labor, and management in the farm business. Comparing and benchmarking NFI to previous years and to other similar farms gives insight to the farm business's performance, both current and historically.